Hi, good morning. So before I start talking, I want to preface this by saying that all opinions are mine alone and do not represent the opinion of the great company that I work for, IBM. Right. So I'm going to tell you a little bit that hopefully you haven't already heard from my good friend Anthony Lewis and also yesterday about what money is. So I love to start with very basics, right? So everyone talks about this. Let's go back to even more basics than this. So we have Alice and Bob. Alice has eggs, and Bob has bread. So Alice wants milk. Bob wants to buy milk. They don't want. Bob doesn't want eggs. Alice doesn't want bread. So what happens in this economy? Nothing. There's no trade. That's not. So this is the fundamental problem of all markets. There's no double coincidence of ones, right? So you cannot have a transaction. Now I introduce a new friend in the middle there. That's Charlie. Charlie is a milk trader. He has some cows somewhere that produce milk for him, and he's willing to buy anything and give you milk, and he's willing to sell you milk for anything else as well. Well, he's willing also to take milk back for some of the stuff. So, under what circumstances would you do a deal with Charlie over here? So it depends, right, on what Alice thinks her eggs are worth in terms of milk. It depends also on Bob, how much milk he demands for his bread, and whether Charlie is willing to take that in exchange. So in a very basic barter economy, this is what happens. You have to keep track of exchange rates between eggs and milk, exchange rates between bread and milk. So this fundamentally is one of the problems that we face in today's world. When you look at what money does, is the next picture here, right? So, well, one thing we gotta think about is, okay, so now you have exchange rates between the different kinds of agricultural products. So, what if we put one more constraint that Charlie only has one cow? Charlie's cow can only produce enough milk for one bottle a day. That's his rate of production. So, who would Charlie sell that milk to? It fundamentally boils down to Charlie's prediction of the future world of eggs and bread. It also boils down to his ability to store that, which I think a speaker yesterday talked about as leverage, right? Storage costs. So now Charlie says, I'm willing to accept tokens. He introduces this idea of a token. He says, okay, I don't just sell bottles of milk now. I will give you, I'm going to set up I'm going to do an ICO on a new token called milk token, milk coin, right? Which is exchangeable for Fitch coin, again. And Charlie says, okay, to Alice and Bob, instead of giving you bottles of milk, because you can't necessarily afford a whole bottle of milk, and I only sell whole bottles, you can accumulate coins, these milk coins, until a point where you can afford to buy milk from me. Okay, so this introduces the idea of savings. So, I mean, yesterday we had a speaker who talked a little bit about how she thought that, you know, all the stuff that we've done with cryptocurrencies, we seem to be reintroducing finance again, right? We've not changed the world very much. But, well, even if you boil everything down to the most basic barter economy here, you have the problem of savings. You need to save for the future. That's the basis of all of finance. You have interest rates, you have savings, because every day when you produce your Alice or Bob, you're baking your bread or you're collecting the eggs from the chicken that you own and feeding it, tending to it, you're building up savings for the future when you have future consumption needs, right? When you want to buy that milk back with the coins that you have. That doesn't change. And so no matter what we go into, whatever token system we move into, whatever new sorts of fancy electronic systems we introduce, it doesn't get rid of the most basic drivers of your needs. You need to get goods. You need to save in order to buy goods in future. You need to overcome this double coincidence of wants problem, which is that sometimes you produce things that people don't want right now. But if you can store whatever your production is, or you can sell it to someone like Charlie here, who's a trader, who's willing to warehouse it and release that in future, who's capable of keeping that milk, bread, or egg fresh tomorrow and the next day and onwards, then you have the capability of consuming more. And that's what drives all economies. We are not going to see a fundamental change in these basic things, no matter what we do with Bitcoin, Litecoin, Bitcoin Cash, or whatever. So now we introduce this next problem, next wrinkle to the model, which is a central bank says, okay, I'm gonna make Charlie's tokens, I'm gonna bless them with these magical words, legal tender. What does that mean? It means that when Charlie offers the coin to Alice to buy him eggs, or the same coins to Bob to buy bread, they cannot reject them. They must accept the coins. Now, the question is, does this change the willingness of all the parties here to make a deal, to do a deal with Charlie? Perhaps they will, because now Alice is sure that when she collects those coins, she can go to Bob, and Bob must take the coins as well, right? There's no way that Bob can reject it for fulfillment of some debt. So, really, if we think to the very, very basic concepts of, we've heard all these words thrown around like store of value, unit of account, and so on. Well, this is what it is. This is what money is, right? It helps you overcome all these problems that you have with the barter economy. So if you take 2 steps back and you think about all the ICOs that we've had, where we issue utility tokens. A utility token that allows you to buy file storage versus a utility token that allows you to buy oil for your car, right? Gas for the car that you drive. Today, we are back to the barter economy. If we succeed in ICOing everything, including pitches, then you can start selling your pitch coin in exchange for oil, right? So I'm willing to be pitched on any number of business ideas as long as you give me oil coins, and then I can put gas in my car and drive home. So we're back to the barter economy. But what's the big difference that blockchain brings to a barter economy that we did not have in the past? Why did we introduce coins in the first place? Because the coin, the token here, is a universally accepted token, right? And that allows us to keep track of only, it's a hub model. Basically, you have eggs versus coin, milk versus coin, and bread versus coin, instead of a complete graph, which is what you need in a barter economy. You need an exchange rate for eggs versus bread versus milk, and every other combination in that. So in the old days, it was very hard for us to keep track of all of that in your brain. But today we have exchanges like Bitcoin who do that for us. All the exchange rates are available online. In fact, you're able to discover prices very quickly because everything is electronic, everything is digital. So any kind of product or service that is internationally tradable, you could conceivably tokenize and introduce a barter economy. So you don't need now to have multiple exchange rates between fiat currencies because you can just do a direct exchange of egg coin versus pitch coin. So I fulfilled my duty to Tim Swanson by mentioning pitch coin a few times. Now, right. So let's go back a little bit to what fiat currency is. Actually, fiat currency is different in different countries. So in Hong Kong, the fiat currency, and in Singapore, fiat currency is actually backed by real assets. So if you look at this chart that I have up there, this is from the Monetary Authority of Singapore, a great central bank, by the way. And in terms of external assets there, you see gold, gold, and foreign investments. The total there is $45 billion in 2014, US. The liabilities that are represented by currency in circulation, that's $33.85 billion. So including all foreign liabilities and provisions, what's outside as money is $35.9 billion. But wait. There's something wrong here with the math. It doesn't balance, does it? Actually, in some countries, I would say, the amount of liabilities, so the amount that the central bank owes to you is less than the assets that they're using to back them. So this is the essence of why some currencies act as safe havens. Some currencies are seen as hard versus other types of currencies that are pure fiat, as in they're backed by nothing but, let's say, government bonds issued by the same government. So the US Treasury and the Federal Reserve, in terms of assets that they hold, they are holding US Treasury bonds, right, to back the currency in circulation. So really, the faith you have in the US government's continued willingness, not just ability, willingness to pay back on those bonds, backs your faith in the currency. Now, what is digital currency? So I'm going to skip this couple of slides because Anthony Lewis just did a fantastic job, although I did an actual flower instead of the picture that he had. Okay, well, so let's think about the desirability of why a central bank would want to think further and issue something beyond currency that you have in your wallet. So this is the Riksbank from their Riksbank report. That's the oldest central bank in the world, the Swedish central bank. And they think that having an E-Krona, an electronic digital currency issued by the central bank, would be great. Why? Because there's a worry in Sweden that most of cash is gone. There is no cash in the economy. And what remains is one single payment system, basically, that runs on one single backbone called bank gyro. All payment systems go through the one backbone. And if you think about this, this is massive, what we call in the industry, single point of failure. If bank gyro doesn't work, you don't even have cash to make transactions. So we'll be back to milk coin. And that's why, conceivably, in Sweden, as a backup to the citizens in that country, the central bank would offer you an alternative electronic payment rail that runs on totally separate technology. Now, but really, if you think about this, is this any better than your current system? No, it doesn't have to be. It just has to be a different system to succeed, right? But in other economies, say maybe in Korea, you don't have this problem. You have many providers, many backbones for electronic payments today. So why would the Korean government want to consider issuing a central bank digital currency at all? Because they don't even have the excuse of a backup system. Now, well, certainly some central bankers think then issuing retail central bank digital currency is a bad idea. So Ravi Menon, who's the managing director or the governor of the central bank in Singapore, says there's a problem. He thinks it's not a great idea. With a bank run, who's going to extend credit to the economy? Mark Carney from the Bank of England says a similar thing, which is that credit allocation by his central bankers across the whole economy is not a good idea. Now, let's step back and see why this is a worry for central bankers, why they're unwilling to do this. So let's look at a bank in Singapore. This is the balance sheet of one of the banks. The color doesn't mean anything, by the way. So if you look at the top there, that's the liabilities and assets are below. Okay. Now, if you look at less than 7 days, that's money they owe to you as a depositor that they have to return to you within 7 days. These are sight deposits. And then below here, you look at loans and advances to customers. Look over there. So people owe them money, and they're going to return that within the next 7 days. The amount that people will return to them is about $27.8 billion. Wait, think about that. There's a problem here, right? So this is the classic borrow short landlocked issue that banks do. This is what banks do. Now, if you think about this particular bank and how its balance sheet is structured, it means that if suddenly everyone who's their customer, the retail customers, takes out their bank deposits and moves it to the central bank as central bank digital currency, what happens? It needs to, all that money, $239 billion could disappear immediately, and it needs to replace that. But the money that's coming in the next 7 days is only $27.8 billion. It needs to somehow go out to the market and borrow. Who is willing to lend money to that bank in an emergency like that? That's the role of the lender of last resort in any country, which is the central bank's role. No, so this boils down to what you saw in the previous slide, which is that that's a credit allocation problem. The central bank has to decide, do I want to lend that shortfall to this bank so that I keep it alive? Now, post-financial crisis, back to that question again, we're back to this, have we, by introducing central bank digital currency, just reintroduced the same problem that we had, which is too big to fail in the first place? Have we reintroduced the same triggers for the financial crisis, which is that the Federal Reserve or central banks bail out all the banks? Do we need the bank? So that's the policy question is, right now, do you need the bank? Yes, arguably, because the bank has lent out all that money to finance mortgage loans. Who's going to finance your mortgage loan then? Do you want the government of Korea to step in, basically for taxpayers, yourselves, to finance all the loans that are outstanding in the economy? That's the uneasiness that central bankers have. So what if we don't have the central bank issue this money instead? We get a commercial bank. So Anthony Lewis talked a little bit about that. But so let's see. Let's just come here, which is, can you find a commercial bank who's willing to issue a central bank digital currency, one for one, fully reserved? And I would argue no. The problem is the rate of return that most banks need to satisfy their shareholders are too high for you to issue a central bank digital currency. Why? Because when you issue a central bank digital currency, you're promising one-for-one backing, fully reserved, which means that all the money sits in the central bank. Unless the central bank is paying you interest on the money that you're putting there, so the bank on your behalf puts the money into the central bank. Unless they're paying high interest, the bank can't offer you interest at all. In fact, the bank isn't making any money off that. It isn't able to make loans off that. So it's not able to make a return on equity, right? Because under Basel rules, the banks have to, it's on their balance sheet. So they have to set aside equity for that, capital for that, right? And that's a waste of capital, basically. So arguably, commercial banks, there is no good reason for a commercial bank to do this. So what's the bad news here, or the good news? The good news is that commercial banks won't do it because they can't afford to. Then it boils down to another realization, which is that you need subsidies. Ultimately, we're back to taxpayer subsidies. So the central bank has to, or the government of the country has to subsidize the scheme, or no commercial bank will ever touch this. So now let's go back a couple of slides. So fundamentally, I think to reiterate some of what Anthony Lewis said earlier. The question is not whether central bank digital currencies are good for central banks. I think the answer is quite clear. It's not very good. In fact, sometimes it's very bad. But why do we keep obsessing about central bank digital currency then? Why do we keep obsessing about having a stable coin? Well, because all our use cases, to fulfill the promise of smart contracts, you need a stable coin. Basically, you need something that has no credit risk, that has assured liquidity, right? So I could get a commercial bank to issue a coin that is fully backed, but that may have no credit risk, but does it have other risks? Yes, it has liquidity risk because the commercial bank cannot print new money unless it finds more money to put inside that pool that backs that issuance. So that's why a central bank needs to do this. And we need to find a central bank to do this because for your smart contract to deal with deterministically, atomically, with swaps and fulfill all the promises of smart contracts, we need to have assets that are fully really on-chain. And that's why, back to the tokenization issue again, we are trying to tokenize all these assets, including central bank digital currency. Because central banks don't need central bank digital currency. The truth is, the crypto economy needs central bank digital currency. So our efforts are really to drive that promise. You have to go to a central bank and say, there's no way you can persuade them to issue a central bank digital currency on its own merits. You have to go to a central bank and say, I want you to help me issue a central bank digital currency because there are all these benefits that come with using smart contracts for X, Y, Z use cases. And fundamentally, I like this picture a little bit, not just because I drew it, but where are we going with all this, right? So the internet in the past, so Swift, what is Swift? Swift is a message transfer service. It's a dumb pipe in between with standards for smart devices on both ends to deal with things. So when you send money through Swift, you're not sending money through Swift at all. You're sending messages about money. You're sending messages about how to transfer that money. And so Swift is not responsible when you have money laundering issues. The banks who are users of Swift at the endpoint are supposed to do all that. Whereas what we're building out today for tomorrow are smart contracts. What we're building out is on a blockchain, most of the time, so Bitcoin, is something where the message, so back to Anthony's point about sending money is sending an email. You have the message with the settlement happening simultaneously on the same chain. So actually the pipe is now theoretically responsible for settlement, which means that you can't take the same excuse that you did in the past, which is to say, I'm just an innocent transfer of messages. If you operate this network, if you own a node on this network, hypothetically, in fact practically, you are responsible for what happens there. So if a terrorist were to use Bitcoin for financing, because the settlement happens with the messaging, I guess we are all complicit with that activity. And so I leave you with the thought that go home and think about this. What is your personal risk appetite? What is your personal view about your responsibility as a user of this next generation of value, the internet of value? What do you think you want to do personally to help to make this a reality? And that's all I have.
Thank you for coming out to the presentation. We look forward to more of your